Welcome to Iraqi Dinar News, where you receive real and authentic updates about the Iraqi dinar. If you want to stay informed with moment-by-moment developments, make sure to subscribe to the channel and like the video. Today, we are diving deep into a comprehensive macroeconomic analysis of Iraq's monetary landscape, directly evaluating recent commentary circulating within the online currency community regarding a potential reinstatement and subsequent revaluation of the Iraqi dinar. Specifically, prominent online commentators have recently suggested that a major monetary event is imminent, pointing toward an official reinstatement rate of $3.22 per dinar. The theory presented suggests that following a specific calendar date, market dynamics will shift, forcing the unofficial or parallel market rate to converge to a neat one-to-one parity with the official rate set by the Central Bank of Iraq. According to this narrative, after achieving this parity, the currency would be transitioned into a managed or free float, allowing it to appreciate rapidly back to its historical pre-1990 valuation of $3.22, thereby executing a formal revaluation. As a professional financial news network, our objective is to separate speculative commentary from institutional economic reality. To understand what is actually happening with the Iraqi dinar, we must look directly at the official policy statements and data provided by the Central Bank of Iraq and the Ministry of Finance. Most notably, the Central Bank of Iraq recently finalized its formal guidance to the Ministry of Finance concerning the draft Federal General Budget Law for the fiscal year. In this official document, signed by the Governor of the Central Bank, it was explicitly stated that the official exchange rate utilized for all state budgetary calculations, oil revenue forecasting, and public expenditures will remain fixed at 1,300 Iraqi dinars per US dollar. This means that the official government peg, which translates to a commercial public selling rate of approximately 1,320 dinars per dollar, remains firmly anchored by the Iraqi state. Furthermore, the Central Bank of Iraq has repeatedly and publicly clarified during its recent policy sessions that there are no current administrative plans or legislative frameworks in place to adjust the official exchange rate or enact a sudden, massive appreciation of the national currency. To evaluate these claims objectively, we need to analyze the specific economic terminology being used. The term reinstatement implies returning a currency to a previous official exchange value after a period of devaluation or restructuring. However, in modern international economics, exchange rates are dictated by a combination of sovereign central bank mandates, foreign exchange reserves, trade balances, and broader macroeconomic indicators, rather than arbitrary reversions to past values. For Iraq to fundamentally shift its currency value from 1,320 dinars per dollar to a value greater than $3 per single dinar would require an overnight appreciation of several thousand%. For a national economy heavily reliant on a single commodity, such an abrupt shift poses massive institutional challenges. Let us look closely at the claim regarding the convergence of the parallel market and the official market. The parallel market, often referred to as the street market or black market, represents the cash exchange rate available at local exchange houses in Baghdad, Erbil, and Basra. Currently, while the official rate is established at 1,320 dinars per dollar, the street market continuously fluctuates higher, often trading around the 154,000 dinar mark per 100 US dollars. This discrepancy, or spread, exists because of structural factors within Iraq's financial system. The Central Bank of Iraq, under agreements with international financial organizations and the United States Federal Reserve, enforces strict compliance and anti-money laundering protocols through the electronic foreign currency auction platform. This system ensures that dollars leaving the central bank are tied to legitimate, fully documented trade financing imports. Because many local merchants and smaller informal traders operate outside the formal banking system or struggle to meet the strict documentation requirements of the electronic platform, they turn to the parallel market to acquire cash US dollars. This creates a continuous, heightened demand for physical dollars on the street, driving the parallel rate up and causing a divergence from the official rate. While the Central Bank of Iraq is working diligently to bridge this gap by expanding electronic payment mechanisms, raising electronic card transaction ceilings, and helping local commercial banks comply with international banking standards to clear trade restrictions. The narrowing of this spread is a gradual regulatory process. It is a slow, structural alignment driven by banking compliance, not a sudden mechanical shift to a one-to-one parity overnight. If we look at the short-term economic implications of Iraq's current monetary policy, the focus is clearly centered on price stability and the control of domestic inflation. Iraq imports a vast majority of its consumer goods, food, and manufactured materials. By keeping the official exchange rate stable at 1,320 dinars per dollar, the government effectively subsidizes the cost of vital imports for the population, keeping the prices of basic commodities stable for Iraqi citizens. If the central bank were to suddenly implement a volatile floating exchange rate system without a mature, diversified economic base, it could introduce immense volatility into the local market. Sharp fluctuations in the exchange rate would immediately disrupt import supply chains, making it incredibly difficult for domestic businesses to accurately price inventory or commit to long-term commercial investment. Therefore, the short-term priority for Iraqi authorities remains maintaining policy continuity, protecting the purchasing power of the local population, and gradually modernizing the commercial banking sector. When shifting our focus to the long-term economic implications, we must analyze the broader fiscal health of the Iraqi state. Iraq is structurally categorized as an oil-dependent economy, with hydrocarbon exports generating over 90% of all government revenues and making up the vast majority of its gross domestic product. The Iraqi government pays public sector salaries, pensions, and funds domestic infrastructure projects entirely in Iraqi dinars. However, it receives its revenue from global oil sales exclusively in US dollars. Under the current exchange rate framework, every $1 billion earned from oil exports is converted by the central bank into approximately 1.3 trillion Iraqi dinars, which is then used to fund the national budget. If Iraq were to suddenly revalue its currency to a rate where 1 dinar equals over $3, the arithmetic of the state budget would change dramatically. A single $1 billion of oil revenue would yield a significantly lower amount of domestic dinars. This would leave the Ministry of Finance with a massive fiscal deficit, making it virtually impossible to meet its extensive domestic public salary obligations and internal operational expenses, unless the country possessed an alternative, highly developed non-oil tax and industrial revenue base. For a revaluation of that magnitude to be sustainable over the long term, Iraq must first undergo a massive structural transformation. This requires diversifying the economy away from oil dependency, expanding agricultural and industrial production, building a robust private sector, and integrating its banking infrastructure seamlessly into global financial networks. For followers of the Iraqi dinar, these structural realities underscore the importance of maintaining a balanced, realistic outlook grounded in verifiable fiscal facts. Speculative narratives regarding immediate wealth generation through sudden currency revaluations often overlook the fundamental principles of sovereign central banking and international trade finance. The Central Bank of Iraq's current strategy is explicitly clear, focused on institutional stability, regulatory enforcement, and gradual financial evolution, rather than sudden or disruptive currency repegging. Watching the ongoing developments in Iraq requires tracking key metric points, such as the steady reduction of the parallel market spread through banking compliance, the accumulation of foreign exchange reserves, the progress of non-oil GDP growth, and the implementation of automated customs and tax systems at national borders. Thank you for tuning into this analytical breakdown. We hope this comprehensive look provides clear, objective value as you navigate the complex economic landscape of Iraq. If you appreciate our dedication to delivering professional, balanced financial news completely free from sensationalism or unverified claims, please remember to subscribe to the channel, click the notification bell, and leave a like on this video. Your support allows us to continue providing the community with grounded, fact-based updates. Please remember that all content presented in this video is strictly for informational and educational purposes only. This broadcast does not constitute and should not be interpreted as financial, investment, or legal advice. Always conduct your own thorough research and consult with a certified financial professional before making any investment decisions. Stay informed, Stay responsible, and we will see you in our next market update.